watching Stock Watch this week. I'm Zinati Guma, and joining me to unpack your stock-related questions today via Zoom are Ricus Reeders from PSG Hole in Ruimsig and Graeme Körner from Körner Perspective. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X @BusinessDayTV using the hashtag StockWatch. Thank you so much for your time, gents. I guess there's a little bit of anticipation as we are heading closer to the 9th of July. That is in, 5 days' time, next week. Graeme, how would you gauge market sentiment and thoughts of investors as we are heading to that deadline?
It's so difficult to say. I mean, sometimes I battle to understand my own emotions. So trying to understand what other people in the market are thinking is quite tricky. I think if my best answer would be there's a degree of complacency. I think people, whether it's around their view on what the Fed is going to do on interest rates, or whether Trump is going to do something insane, the markets seem to be kind of shrugging off the risks. So the best I can suggest is that the markets say, it's not going to be a big deal. They'll roll this back, to the taco trade all over again. And I think it's evidenced by the fact that the S&P and the Nasdaq are pretty much in record territory. So, I don't think the market is really baking in any lasting impact. But as I say, I think that's maybe a little bit too optimistic. I think we priced in a lot of good news and not a lot of risk.
And it's actually quite interesting because I thought that after that US jobs report for June, that surprised to the upside, that the markets would actually be worried that, the Fed is going to take too long now to cut rates. And I'm wondering, Ricus, why the markets are shrugging this off, or had they already accepted the narrative of the Fed that they're not going to be cutting interest rates, but also at the same time thinking that even if the Fed doesn't cut interest rates, nothing's going to break?
That's possibly part of the answer, but I think people forget two other important factors that's been driving the American market higher. First of all, share buybacks by American company, I think, is at its highest level ever.
Wow.
That tells you that companies are saying, well, we don't want to invest in our operations. We don't know what else to do with our money. Therefore, we are buying our own shares back. And that puts positive momentum to the market in any event. So forget about the sentiment. It's just a physical buying of shares by companies that's been driving American markets. The second thing is that the effects of April's volatility after Trump announced his tariffs, that's moving out of the system. So a lot of fund managers, including me, have been hedging against volatility. But as that volatility measure decreases, we now find ourselves possibly too liquid, and whether it be because of the mandate or because of the fund managers' attitude, there's a buyback happening into the market of fund managers who are underweight stocks. That's driving price momentum as well. So what's going to happen with tariffs going forward, as Graeme says, who knows what's going on in the mind of Mr. Trump? But the fact is, he has blinked to a certain extent by already stating last night that he's now sending out letters to various countries, just basically imposing a thumbs-up tariff on every country, because the negotiations with countries surrounding tariffs weren't going anywhere.
All right. Well, just on the subject of companies deciding not to put their free money into operation upgrades, rather buying back their own shares, of course, that then brings a lot of value to what investors are holding. I want to switch to Rainet, because a lot of people are kind of watching to see what Rainet is going to do. Of course, they did confirm that they are selling their almost 50% stake in Pension Corp to Authora Holding. Yeah, that didn't take very long. Graeme, what are investors anticipating at this point? Are there any ideas, any options that investors are anticipating in terms of what Rainet could do with all that money?
No, it's almost, if they sell this, it becomes a cash shell. So then you sort of ask yourself, if you haven't got something sensible to do with it, because remember, they've got out of British American Tobacco. So, Pension Investment Corp, Insurance Corp, if I remember correctly, represented about 60% of their NAV. So, then it shouldn't trade at a discount to NAV. So, unless they can find something to do with it reasonably soon, I think you may very well see that one returning a lot of that cash to shareholders. But yeah, it just reminds me also the fact that for a long time it traded at a reasonably big discount to NAV. Market didn't trust the valuations, and we've seen it out of a few of the these very unfavorable or unpopular, unfashionable investment holding companies that are trading at discounts. Just reminds you how quickly you can get flat-footed by them. So I think the short answer is I think the market is probably saying, on balance of arguments, they would look to redeploy. Just based on what the price action has done.
And the thing is, Pension Corp actually raised the bar quite high because of just how good the asset is. Ricus, at this point, would it be difficult for them to buy another asset that maybe might not be on par with Pension Corp?
Well, maybe they get lucky, maybe they don't. I mean, there's a lot of luck involved in the investment process, whether it be from me and Graeme's side or just a company sitting on a cash pile and having to find an avenue for it. I think in the end it depends on what Johan Rupert wants to do. I mean, it still is a family governed company, so I don't have any bright ideas. Maybe they do.
All right. Well, I want to actually, Graeme, before the show, you actually mentioned something that was interesting. That's kind of a continuation of what we were talking about yesterday. So yesterday, a viewer was talking about City Lodge and Octo Deck, about how they pay dividends, but then the share prices aren't really moving, going anywhere. And we also got into the case of them being smaller caps where there isn't a lot of liquidity. And you actually said to me that there can be advantages found for retail investors, and particularly in the small and mid-cap space. How are you viewing that, and particularly looking then at the fact that you may be stuck with some illiquid counters where they are doing the things, but the share prices aren't going anywhere?
Yeah, look, that's a complicated question.
Yeah.
I would start with, you need to be comfortable with what you're buying. It's as simple as that. So, if you look at City Lodge and you say, I trust the underlying, and although it's not a to blow your hair back kind of company, it's solid. It will deliver through the cycles. It will deliver solid earnings growth. And the dividends will ramp up, for example. So if you look at it and you say, yeah, sure, the world has changed a bit. COVID obviously illustrated that. But if you say, well, it's been operating the same model for 30 years, and it's still a viable model, and it's properly run, and it trades at a discount to its intrinsic value, and you can take a long-term view, then I would argue, well, who cares about the liquidity? So I would couch it that way. And I'd also say, one of my poster children for poor liquidity and, a share that almost suffered from what I call sick share syndrome, where, it just was trapped in a range in spite of it seemingly doing good things, was Argent. If you look for a long time, management were pedaling like crazy. They were working the debt down. closing loss-making operations, but they peddled like crazy, and the market just never rewarded them. It traded at R4, now it's trading at $27, and I would argue it's still worth buying at 27 Rand. So I think quite often when you've got this negativity, and I think at the moment there's just a lot of there's a finite pot of capital looking for work, and the easiest thing is you just track the theme. So if it's gold, you go gold. If it's platinum, you go platinum. You know, if it's Rand hedges, you go Rand hedges. And most people aren't stupid enough to do what I do, which is try and look at these small companies that are unloved, because they can move the needle for a private client. But you can imagine for a 91 or a Coronation or an Allen Gray, you know, for them to try and pick up a meaningful stake in a City Lodge, it doesn't move the needle at all for them. But I think, so in answer to the question about what about the lack of liquidity, if it's a good company, I believe the liquidity will eventually take care of itself, and it'll go from possibly being, you know, and I think Ricus summarized it beautifully, you know, more buyers than sellers. But often in these small caps, you just got this perpetual wave of selling with very little buying interest. And then suddenly when that turns, then the liquidity actually goes and turns in your favor. So, but I think what I'm saying is start with the story. If you believe in City Lodge or Argent or Cup or whatever the case might be, the liquidity for the average private client is not a big deal.
Okay. Ricus, how would you be approaching that small cap space?
Well, small, medium cap companies that I like are defined by two things, in my opinion: a cash flow that's positive and dividend growth that's positive. If you're in a company that manages to increase the amount of dividend it pays out to its shareholder consistently over a number of years, that kind of company tends to outperform everything else. Secondly, small to medium cap companies, I also think, can only go two ways. Oh, actually three ways. They can either go bust because they're small and they don't have a competitive advantage. They grow into big cap companies, which is, you know, great. You know, Capitec, for example, is a prime example of that. Or thirdly, they get taken over. They get bought out. So the only risk you have with a small company is the thing actually going bust. And the way to guard against that is take a look at their return to shareholders. That's incredibly important. I don't normally quote Warren Buffett, but he said in a financial statement, there's two numbers you can trust. The one is the page number, the other one is the dividend number. So that's the way I would approach it.
Page number and dividend number. All right, I've got you. Let's get into more questions, gents. And I want to start off with Telkom. I sold the Telkom shares a month ago. The share price is soaring. Not sure if I should get back in at the current price. That's quite a difficult one because obviously a month ago the shares weren't as high as they are right now. We've seen that share price rallying and rallying and rallying. But I mean, as much as we are seeing the positive fundamentals of the company and how much has gone by, Ricus, do you not think that the easy money has been made right now and actually maybe it wouldn't be so wise to get in at this point? Or is there still some value even at this price?
No, I think there's still some value in at this price, and I won't be surprised if they go and retest their, 90, 100 Rand high. They're not expensive. They've got market momentum and sentiment behind them. They might, they've had quite a price rally, and there's always, drawdowns on rallies like this. But I don't think, longer term, it's been in the sector that's, apart from gold and platinum, probably the best industrial sector in the market. So I'm quite happy to hold it, and if you want to buy it back, possibly buy it back on any price pullback. But the person that asked the question should really review and say, okay, why did I sell it? Okay. If that was if there was method in that, then don't, and that method works for you, then don't deviate from that just because the price is moving against you. It just means that that the price is moving against you doesn't mean that you need to go and adapt your method.
Yeah, it's quite interesting because I'm sure she made a lot of money even with the sale, but then she's thinking, well, I could have made more money. Graeme, what do you think when what do you do when you're confronted with that, and just your view on Telkom as well?
Yeah, I suppose it's, you just, I think Ricus summarized it well. You just move on.
Yeah.
We don't know what she did with the money. For all we know, she might have bought Valterra Platinum, or, and I think that's the reality. But I think Ricus hit the nail on the head. She obviously bought it originally for a reason and sold it for a reason. Hopefully, with some level of fundamental view. If she bought it because she thought, that the sector's unloved and it could bounce, and she made her money on that, then I would say, well, thank you very much. It's a difficult sector, if you have to be honest. I think the SA, particularly the SA telco space, is not. I don't share Ricus's optimism about that. So I would say, fundamentally, I would rather not be in the telcos if I took a long-term view. But having said that, I think there is short-term momentum. I didn't go into the numbers in any degree of detail, but I think they looked better than they actually were, and maybe. One of the problems when you sell your crown jewels like masts, then it comes with long-term consequences. So I think fundamentally, I would personally rather not be invested in Telkom or MTN or Vodacom at this stage. So, don't look over your shoulder, don't cry in your beer, and just move on.
We're talking about taking your money off of a counter and redeploying it somewhere else. That's what this next viewer did. I recently disposed Sasol, mainly due to their structural challenges, and invested in Occidental Petroleum at $43 on the New York Stock Exchange. Previous highs were around $100. Both businesses in the same industry. Your view on this move? I don't know how closely you watch Occidental Petroleum, Ricus. We know that Berkshire Hathaway has a stake in it, but I have often heard analysts saying, just take your money off of Sasol and actually go for another oil counter internationally, because those are doing better. They don't have as many operational headwinds as Sasol. What would be your thesis here?
Okay, let's talk about Sasol first. I've been one of those that have been saying, go and put your money somewhere else, and I still think that would probably be more prudent. But PSG, our company, released an interesting analysis on Sasol a few days ago, and according to the analysts' calculations, if you take a look at the breakup value of Sasol's assets as it is now, it's basically equal the share price. So you're getting Sasol for the breakup value. I would tend, if that's your baseline, I would tend to say, if you can stand the volatility, because that price is going to be volatile, don't be surprised by 20% moves in the thing. Maybe consider having a speculative position in Sasol, because if you can buy that at, as I said, breakup value or estimated breakup value, there's quite a bit of upside in that. But Occidental has been bought. I think Graeme probably knows more about the company than I do. But it's obviously more mainstream rather than Sasol, which is that split between oil and chemicals. I know Occidental's really concentrating on carbon storage, so that's an interesting avenue of growth for what is an oil company.
Well, I mean, you have a company that Warren Buffett has a stake in, and one company where he doesn't have an interest. I mean, is this not a no-brainer, Graeme?
I don't know. I mean, obviously, Berkshire are very, very capable investors, and they've been building that position in Occidental. And if I remember correctly, they've actually got options to increase their stake, and I think they're almost at 30%. But I don't know enough about Occidental specifically to comment. But I think what Ricus was saying on Sasol is actually quite right. That it's a company that's really a a shadow of its former self in terms of market credibility and visibility. But having said that, you do feel at $80 or $85, there's quite a lot of bad news baked in. And if they were able, for example, to list the chemicals business separately, or pull some other rabbits out of the hat in terms of unlocking some of the inherent value, my sense is that it's probably worth more. The question about, redirecting your money from Sasol, if I look at Occidental, for example, I think the price has lost about, half its value over the last couple of years. If you look at something that we hold internationally, which is like Shell, for example, it's done a lot better. So I would argue I'd rather be in one of those purer plays. Okay. But coming back, I agree with Ricus. I think from a slightly more speculative point of view, hoping and praying that the Rand oil price doesn't move too much against them and that chemical prices start to improve, because obviously chemical markets have not been helpful for them. There is a spec opportunity, I think, in Sasol, but so many people have been disappointed by it for so long. My sense is, if you tell 10 people to do that, if 9 of them have held Sasol before, chances are they'll say thanks, but no thanks. It's that kind of story. It's just been so disappointing for a long time.
All right. Well, let's get to your stock picks for today, gents. Ricus, what are you hanging your hat on today?
It's NXP Semiconductors. The semiconductor stocks have been running. NXP is a little bit different. They are a semiconductor business, but they're based in Europe, first of all, so we don't have to worry about the US problem. Secondly, they are concentrated, or their market is a little bit different from others. They're heavy into the automotive side of things, specifically driverless driving, specifically in things like radar. So they don't have the competition from your high-end developers like NVIDIA, for example. And the same goes for their industrial chips, which is meant for heavy industrial use. In other words, in difficult temperature environments, in difficult operating environments, very much a leader in that sector. So I think it's differentiated enough to give them a bit of a moat. I think that whole industry is still looking pretty well. And considering they're on a price earnings of about 25, I don't think that's expensive with forward growth of at least 15 to 20%. And again, price graph looks quite interesting, and I'm fairly sure that they'll recover about the 20% that they are down from their previous high.
All right. Graeme, on your side, where are you finding opportunity?
Going for the old cowardly option. ABSA is sitting on a forward multiple of about 6 to December. I think the divi yield is probably around 8.5. I have to ask myself, how wrong can you actually go when you're getting a dividend yield that beats cash, even almost after TWT? So, I think they've seen some very exciting leadership changes. There's a lot of excitement around that maybe this repositioning of the inflation target could see the sort of what I believe to be South African interest rates, administered interest rates, being anchored at very high levels. That could really, take the handbrake off. But what I'm saying is it's just too cheap. It's not like it's a rubbish company. It's just relatively unloved in the sector. So I think ABSA, with these sort of multiples and the near-term fundamentals that we see, I really think it's a kind of a heads you win, tails you shouldn't lose kind of business.
Lovely. Thank you so much for your analysis today, gents, and do enjoy your weekend. Thanks to my guests, Ricus Reeders from PSG Hole in Ruimsig and Graeme Körner from Körner Perspective. Do remember that Stockwatch pre-records on a Monday and Wednesday at 1 p.m. and is live at 6:30 p.m. on a Tuesday and Thursday, while Stockwatch this week is live at 12:30 p.m. on Fridays. Do keep that in mind and keep your questions coming. For now, that's all from Stockwatch this week, but do stay tuned for lots more coming up right here on Business Day TV.